So the purpose of these sessions is they're going to be kind of weekly, and just join in. What we're going to do is we're going to try to go through the stuff that I've kind of picked out for the blog during the week. For those of you who don't know Snippet Finance, it's basically, that's the website, www.snippet.finance. It's a blog that I write, and the purpose of these sessions is kind of, I'm going to pick out a few ones and just kind of talk you through why I picked that one, why I thought it was interesting, and what the implications of it are. So it will be, at the end, feel free to ask questions about it. We'll try to keep to 1 hour. I'm probably not going to talk more than sort of 15, 20 minutes. And so we can just dig straight in. I'm just going to start from the beginning of the week and look at all the different snippets that have been interesting during the week, and then just save your questions till the end. Okay, so let's start with the first one. So this starts kind of on Monday. So a lot of you have probably heard of Paul Tudor Jones, and if you haven't, you probably should look him up. He's a very successful investor and hedge fund manager. He's got a bit of a trader's mentality, but it's always very interesting to think about kind of how traders behave in all these different markets, especially very recently. And he's recently penned this piece together with one of his colleagues on kind of inflation, gold, and also Bitcoin. And that because he sort of made an investment in the latter recently. So I just kind of want to say a note before we continue with any of this, is that when you read stuff about other people doing investments and things like that, the most important rule is use your own common sense and judgment to decide whether that's a good enough investment for you. You have no idea what else he's got invested in, you know, how many hedges he's got on, et cetera, et cetera. And so every time you think, oh, this could be a good investment for me, make sure you do your own work and apply your own common sense to it. And this will apply throughout all of the sessions. So he's written a piece, right, about this. And I kind of thought it was quite an interesting piece. So if you do think that's interesting, go ahead and click on that link, check it out. But I thought the most interesting thing he did was put together this chart. So this chart is just quite an interesting way of thinking about the valuation of gold. Now you probably know gold is a bit difficult to value because, well, what is it? It's just a metal that kind of sits above ground. One of the ways he's done it is that he's got this long-term chart. I'm a big fan of very long-term charts because you can see a lot of trends, and this goes back to 1921, so almost 100 years. And what it does is it plots the price of gold, all of the gold above ground. And you can imagine over time we were mining a bit more gold, and very recently we haven't been mining very much, against global M1. And M1 is like a measure of money. So what this tells you is how much gold is there versus how much money there is. And we divide one by the other and we have a valuation metric. And what it's telling you is that certain peaks, right, we've seen before historically, actually the current peak doesn't look that out of place, right? And what he's saying is that that means that he thinks that the gold price is going to go up. But I just sort of encourage you to read the piece. It's very, very interesting. It's just kind of gives you a bit of a view about one particular type of asset. So the next snippet I'm going to tell you about is called 13 Fs. This is a really, really useful thing to know about. So in the United States, the Securities Exchange Commission basically makes every fund report all of its holdings quarterly. There's a bit of a delay, like a month or so. So you're looking at what is a kind of stale portfolio. But for some long-term fund managers, it doesn't really matter. They don't change their positioning that much over time. But it's a really useful thing. And I thought it would be really interesting to point that out now because, well, we've just had probably one of the craziest quarters in stock market history, if not, and definitely in the last decade. So it's quite interesting for you to click in, see what all of these famous fund managers have done. And there's a link down here, which tells you, which actually is from Zero Hedge, which is another blog, but he kind of kindly summarizes what all of the major famous funds that you would have heard of have done on the quarter. Remember, this is just a long side. So they might be doing something else crazy on the short side if they're a hedge fund. But on the long side, this is what people have been doing. So we just started to look into that, think, okay, there was a big dislocation. What have people bought? What have people sold? Why have they done that? And again, I'd caution, use your own common sense because it's kind of not about doing exactly what someone famous does, right? Because they have other motivations and things like that. So definitely check that out. It's very, very interesting. All right. So the next one is about value investing. So you, again, if you've sort of followed the financial debate, you'll know that value investing is a very strong investment strategy and has been very, very successful over 100 years or so of people investing in stocks and various types of securities. But what you've had is a recent period of serious underperformance of value, especially against growth stocks. And there's a lot of people who write thought pieces trying to understand why that has happened. And this, I thought, was a really interesting piece, because what they do is they say, okay, well, could it actually be valuation that was the reason why value stocks underperform? I know that sounds a bit strange, because you wonder, valuation, surely value stocks are the cheap ones. But actually what they're pointing out is that we've used the wrong metrics to categorize what cheap is. So we've looked at price to book or price to earnings ratios, which you might have heard about. And for example, if you look at the price to book ratio, they've said, you know, it's probably not a great metric, because what has happened, which is written down here, is that since 1985, you've had this massive drop in the percentage of market capitalization that's explained by tangible assets. So things like factories, etc. So actually a metric like price to book has probably become less relevant than perhaps some other metrics. And so what they do is they look at free cash flow to enterprise value. And so this chart compares kind of what the growth index looks like versus the overall index. Sorry, the value index looks like versus the overall index. And what it's telling you is that after 2007, which is basically when value started to underperform, you didn't really have a massive valuation argument to buy value based on this particular metric. So it could have been that actually value stocks weren't that cheap, and that's why people didn't really like them that much, and if you focus on this particular metric. So it's something to kind of think about when you're thinking about kind of how you're looking at the world and understanding why things have happened the way they are. Actually, if you look back historically, maybe it was just explained by people looking at the wrong thing. So I thought that that was quite interesting. And there's a nice piece here in the link that kind of explains all of this, and it's probably an interesting thing to read if you're interested in this topic. And that's the other thing to take away from snippets. Snippets, the idea is I'm giving you a little nugget of information. It might not be interesting to you, that particular one or the other one. And the idea is that if you are interested in this, this should be interesting to someone else as well. And then you can use it to impress your boss or impress at interviews or whatever it is. Right, so let's move on. So this was one of my favorite ones I wrote this week, which is called Behind the Scenes. So I'm an equity investor. I've been doing this for sort of 10 years. And for me, one of the most typical things you do as an equity investor is you meet the management team of the company. So the CEO, the CFO, and often the investor relations team. But what I used to love to do was to go and meet and talk to the other people involved in the company, particularly people like the chief technology officers. So remember, the world has kind of changed now. You have a lot more technology, and technology is driving businesses forward. And this is the person, man or woman, in charge of basically delivering the technology side of the business. And so I kind of wrote this post because I found this really interesting article from the outgoing chief technology officer of New York Times. Now, if you follow New York Times, they've gone through a massive digital transformation in their business. They've essentially gone from kind of an ad-supported newspaper to having a huge subscriber base online. And it's a really interesting kind of business case study to think about. But listening to what he's saying, it's just quite interesting, in my opinion. I just kind of jump on these pieces every time because, you know, he's kind of the reason behind this business has changed. The other one I point out, which I kind of stuck along with this, is a really cool podcast from the chief general counsel or the general counsel of Netflix. Why did I put that there? Well, again, it's all about trying to understand what is going on with the business, right? And within media businesses, the legal department is actually quite important, what they've been doing. He's also really interesting because he was the first lawyer they hired. So he's been there since Netflix used to send out DVDs. I mean, all of you are probably too young to maybe remember this, but Netflix started as a company that sent out DVDs to people, and obviously is now a huge streaming business. And he was the first lawyer, and now he has a team of 650 people. So again, it's quite interesting to hear from people who've seen a transformation of a business like that from behind the scenes. And so I'd encourage you, when you're looking at companies, to think about, well, should I be really just, you know, the CEO is the CEO, right? But maybe there's other things I can find out about the business from reading other people. So that's a really interesting piece there. Moving on to the next one. So this is ESG investing. So as you can see, Snippet tries to kind of jump around to give you lots of kind of a broad range of interesting things that you can use in your real world. Some of them will be interesting, some of them won't. So ESG investing is called environmental, social, and governance. And this is the idea of investing in businesses that are good, or trying to do something good, or aren't bad on these scores. So environmental is quite obvious. Social is things like employees and stakeholders and society in general. And governance is essentially how a business is kind of run. Is there a separation between the chairman and the CEO? Is it kind of a really well-run business for its sustainable future? So it's a big theme. Corona has maybe put a bit of a dent in this theme, but it's still something that I think once we're out of the pandemic is going to be very, very important to think about. And I thought that this chart was really interesting. It comes from Merrill Lynch's research on ESG. Hopefully everybody can see it. Do you want me to click onto the thing, or let me just do that anyway? Right, here you go. So this is the chart. So you can see what this shows you is the relative forward PE. So this is the valuation metric of the stocks that were the top versus the bottom quintiles, right? So the top and bottom parts of the MSCI ESG score. So MSCI basically scores companies. It puts a certain score on those companies based on ESG, and then it ranks them based from top to bottom. And this is the relative valuation of the top versus the bottom. So you might have seen charts showing the performance of stocks and things like that, but I think valuation is much more important. And what it's telling you is that you've had this kind of almost step change since 2016 in terms of how these stocks have been valued relative to each other. And the question is this trend going to continue? And I mean, I'm probably in the camp that it is. And it's very important to think about whether the stocks you're investing in are going to rank well on ESG. So if you've got a load of arms and tobacco stocks and things like that, you're probably not in the best place, whereas other companies are probably quite well positioned in this space. So let's head back to Snippet. So that's a bit about ESG. And obviously what I'm saying here is that after the 2019 gyrations that we've had, I think this trend is going to continue. And that's why I kind of put up this chart. The next chart is, I guess, a little less positive, which is kind of trying to understand what is going on in the macro world right now. I'm a big fan at looking at industries that have been around for a very long time when it comes to economic impact. And rail is the perfect example because, well, railroads have been around in the United States for 200 years or so. And this is why I thought that this quote was quite striking. They're saying any industry that's been around for 190 years basically has seen a lot of stuff. And they're saying we've never seen anything like this. So it's kind of it's quite a shocking statistic. And if you look at this chart, which is basically US total rail carloads, which is how much stuff is being carried around in the US economy. And rail is kind of the vein that holds the economy together. I mean, you can see what's been going on. Now, this could be quite temporary, it could come back or not, but it's just quite an interesting stat from an industry that has been around for a very, very long time. It's seen a lot. And if you click through to the link, you'll see like a lot more information. If you decide, you know what, I'm kind of interested in rail, or I'm looking for a macro metric that I can track. They pretty much track this weekly. So it's quite high frequency data. So it makes it really, really interesting to kind of look at from an investment perspective. Right. And you would have seen maybe in some of the other snippets, if any of you have been following, this comes from a site where they follow like a few really interesting metrics, and I'll put them up over time as well and highlight them. So the next snippet is just something a bit more fun and interesting, which is because I think in investing and in life in general, it's all about kind of having a broad range of experience. And hopefully what you'll get if you sort of keep reading Snippet is you'll get a bit of a sense that actually there's more to life than just finance or charts or things like that. That there's a lot of really interesting ways of looking at the world and understanding the world, and maybe a few lessons to be learned from other people and other things. And these lessons, I know, might sound kind of really far away from what you're thinking about, which is your studies and your work and your investing career, but actually they will have a lot of really interesting implications for that as well. So I try to put these up sometimes. So this is a commencement address. So some of you, I'm a student as well now, will be missing your graduations, and you probably won't get a commencement address. It's a big thing in America to invite really famous people to give an address. I remember when I was at LSE, we had one, but some other universities don't have it. But what The Atlantic, which is a really great publication in the United States, has done is put together a series where they invited authors to write a commencement address, basically that would not be there. And I thought this one was excellent. And it talks about this concept of the theory of maximum taste. Now, I'm not going to reveal what that is. I just encourage you to just go and read that for a bit of something interesting and fun and motivational. And then I always kind of started thinking about commencement addresses in general. And I thought, actually, it'd be cool to put this one up, which was done by J.K. Rowling, which all of you will know who that is, for the Harvard class of 2008. And to me, this is the most inspirational address I've ever heard. I mean, I'm not ashamed to say that, you can definitely shed a tear listening to this. It's really, really powerful stuff. And it's just kind of fun. It's 20 minutes. If you're kind of bored to sort of do and want a bit of inspiration in life and want a good lesson and sort of missing your own commencement address, click through this series, read that article, and then watch the thing. It's just a bit of motivation, isn't it, in life at this point? Right, moving on. So then as I said, you can see Snippet jumps around a lot. So there's no real sort of single theme. I'm trying to pull out lots of interesting things that are going on in the world to give a broad taste for people who are in the investing world and are interested in understanding what's going on. Because if you don't know what's going on in venture capital, for example, you don't really understand what's going on in tech or the new crop of companies that are coming through. You probably don't really understand kind of how even normal businesses like people who deliver coffee, etc., are going to be impacted by some of these new ventures. The other thing you should know about is let's say you're invested in a share and you're thinking, how is my share going to be invested by technology? Well, the best place to look is where are venture capitalists putting their money? If loads and loads of money is entering a particular sector, like let's say food delivery, and you happen to have a restaurant company, you should start thinking, how's this going to impact? Venture capital tends to be quite blind. They just throw a lot of capital behind it. So it can be quite dangerous when it comes to competition. So I was reading a report by this bank in San Francisco, obviously at the heart of venture. They know exactly what's going on. There's loads of interesting charts in this link here. And what I would say is that I picked out this one, which I thought was the most interesting to me. So they have another chart within there, which I didn't put, which says that venture capital funds who were basically founded during the dot-com bust actually had a lot of lower variation in their performance the next time a crisis happened, which was the global financial crisis in 2009, which I think is really interesting, isn't it? So it's sort of saying there could be lots of reasons that explain it, but it could be that experience matters in venture capital, right? That it is important how much experience you've had previous economic hardship. And then they put up this chart, which tells you that about 61% of today's, which is the majority of venture capitals, have basically never seen an economic problem. And I would say there's by the way, an equivalent chart for fund managers who haven't seen a financial economic crisis before. But it probably tells you something a bit worrying about how these people are going to be looking at their investments or understanding, because they haven't experienced it before. So you might wonder, okay, well, why are you putting these up? Well, it's just to kind of motivate you to think, right? If these guys have never seen any sort of trouble, how are they going to make decisions, right? Are they going to act really brashly and pull back? Are they going to be quite aggressive? You need to kind of be thinking about that, because that's going to determine what's going to happen in the next couple of years, right? As we come out of this crisis. So I like to put up these charts to kind of motivate people to think about something. I'm not going to give you all of the answers, and over time you'll have the answers yourself, but it's sort of, oh yeah, that's really interesting, and you take it away and you think about it, and that's the whole point. So moving on to the next one. So this one's about cruising. So now I'm diving into a particular sector that's been really hard hit by the coronavirus, but I'm actually kind of painting a positive picture. So this is a really cool service. They're called ThinkNum, and they present alternative data sets. So again, all of you should probably know about this service. They scour the web. They use lots of different sources to figure out what's an alternative data source on a company or a stock. They don't always have they, for example, do things like hiring or how many people are posting on Instagram about a thing, but it's still quite an interesting alternative data source to look at. It doesn't give you all of the answers. So they've been tracking pricing for cruises. So what has been going on? Obviously, there's been a massive collapse in pricing. These are all different types of rooms you have in cruises. But what's really interesting is that it kind of looks like it's stabilizing a bit. And then there's an article I've linked here, which talks about cruising demand. And you probably don't know much about cruising as a sector, but it's mostly an older population that goes cruising, and they're fanatical about it. They love it, and they go on a cruise every year. And so what it's telling you is, okay, maybe there's an interesting investment opportunity here. These stocks have collapsed. A lot of them have recapitalized, which is what I put here, and are going to start cruising again soon. So maybe, again, with all of the usual proviso, as it's not an investment recommendation, but maybe there's something interesting here to look at. And I've certainly been looking at this sector and thinking, actually, this could it could survive, and the share prices could all recover very quickly if there's such a big underlying demand. And obviously these companies have had, 4, 5, 6 months to figure out how to be safe on board. So, they're probably going to have rapid testing right as people come on board, et cetera, et cetera. So that'll be placed very well. And so jumping to the final snippet, which is about insurance. So again, I'm diving in a little bit at the end of the week to a few sectors, right? And I'm thinking, okay, what's going on with these specific sectors? And this is a really interesting chart about insurance. Now, again, a sector you probably don't know anything about. And I'm a generalist investor. So as you can see, I'm kind of reasonably comfortable jumping from cruising to insurance. Not everyone's going to be comfortable doing that. And insurance is a very specific sector. But what people don't know about insurance is that bad times are actually kind of good for insurance, because what happens is that, yes, they'll have to pay out all of these business interruption claims because of Corona. And there's going to be lots and lots of other insurance claims they're going to have to pay out. But what you see on the other side is some players fail, some players have their capital reduced and basically don't have enough capital to deploy in the market. And what happens is pricing tends to harden. And it's called hardening of the market. And that actually is very, very positive for the profitability of insurers. And this is the Marsh Global Insurance Market Index. This is around the world. And you can see what's going on with insurance pricing. I mean, plus 14% is, I think, the highest increase they've ever seen. So we've seen this unprecedented hardening. So it's a sector where if you're happy to take the risks that some of these claims might be a bit bigger than people think, there could be a really interesting opportunity there, again, with all of the caveats. So hopefully this is giving you a bit of like a tour, a wrap of all of the kind of interesting ideas that I've kind of found over this week. I'll be doing this kind of every week, so you can come in, listen in, hear a bit more information than you would just reading this. If you haven't seen the site before, it's basically snippet.finance. You can basically see it's kind of just a flow of snippets. You can go back to historically. There's a lot of categories here, which are big categories. You can also click on tags, which are here. And if you click on tags, they're like specific topics. Oops. Here we go. I mean, I sort of tag a few specific topics if you're more interested in those. You can use the search function. And then if you're really interested to receive it, there's a sort of email that goes out 3 times a week. You can subscribe to it here. And the idea is, as you've seen, collation of interesting bits of information that have inspired me and hopefully will inspire you to think a little bit more about the world and what's going on out there. Again, you've probably also noticed the financial knowledge level is a bit higher maybe than you maybe expected. I'm not going to explain a lot of basic financial concepts. I mean, SEO provides loads of really interesting resources. Read those. There's loads of stuff online. Anything you don't understand, look it up yourself. The best way to learn is just looking it up yourself. And then over time, you'll kind of understand a bit more.